Hello everyone, welcome back to day 27 of our trading podcast journey. Today's episode is one that every trader, regardless of experience, needs to pay close attention to avoid the common psychological pitfalls in trading. We often focus on strategies, technical skills, and financial goals, but trading psychology is just as important. Emotions can quickly cloud our judgment, especially when we are in the heat of the moment. In this episode, we will dive into some of the most psychological traps traders face and how to avoid them. By learning to master your mindset, you can avoid impulsive mistakes, stay disciplined, and make better trading decisions. So let's get started. Trading is as much a mental game as it is a technical one. Our emotions and biases can significantly influence our trading decisions. In fact, research shows that emotional decision making is one of the biggest factors that lead to losses in the market. Imagine you are in a trade that is quickly going against you. Panic and fear might push you to exit too soon. Or if you are on a winning streak, overconfidence could lead you to take on excessive risk. These emotional responses are natural, but they are also dangerous if not controlled. Today we will go over several common pitfalls and practical ways to stay grounded. Let's go through some of the most common psychological pitfalls traders encounter and discuss how to avoid them. The fear of missing out, the FOMO, is when you feel compelled to enter a trade simply because others seem to be making profits from it or because the price is moving fast. This is especially common during market rallies or sharp price movements. Overtrading. It happens when you are constantly opening new positions, often due to impatience, boredom, or the desire to win back with the recent losses. It can quickly drain your capital and increase your exposure at risk. Revenge trading. After experiencing a loss, some traders immediately try to earn back what they have lost by placing another trade, often without a clear plan. This emotions response, known as revenge trading, usually leads to even greater losses. Confirmation bias. It is when we only seek information that supports our existing beliefs. In trading, this might mean ignoring signs that a trade isn't working out because we are overly focused on information that validates our view. Loss aversion. It is a tendency to avoid realizing a loss, which often leads traders to hold on to losing positions longer than they should, hoping the price will eventually turn around. Now that we have identified some common psychological traps, let's look at techniques to strengthen your mental discipline so you can manage emotions better during the trades. Using a trading journal. Keeping a journal is one of the best ways to track and learn from your emotional responses. Write down the reason for each trade, how you felt before and after, and any emotional reactions you noticed. Reflecting on these entries can help you identify patterns and make adjustments. Develop a routine for mental preparation. Establish a pre-trading routine that prepares you mentally. This might include deep breathing exercises and a trading plan. Preparing your mind can help you enter the market with a clear and focused mindset. Set realistic expectations. Many traders fall into psychological traps because they expect fast or unrealistic returns. Accept that trading is a marathon and not a sprint, and set realistic goals. A healthy trading mindset is one that balances confidence with caution, ambition with patience. Here are a few final tips to cultivate this mindset. Detach emotionally from the individual trades. Try to see each trade as one of many over your career. Rather than focus on individual wins and losses, assess your performance over multiple trades. This perspective can help you avoid the emotional roller coaster of trading. Embrace losses as learning opportunities. Losses are inevitable, but they are also valuable teachers. Instead of viewing a loss as a failure, treat it as a feedback. Ask yourself what you can learn and how you can improve for next time. Revisit your goals and motivation regularly. Remind yourself why you have started trading in the first place. Reconnecting with your goals can keep you grounded and help you stay resilient even when things get tough. So let's quickly recap what we have covered. The psychological pitfalls like FOMO, overtrading, and the loss aversion can derail even the best trading strategies if left unchecked. Strategies like using a trading journal, setting realistic expectations, and developing a pre-trading routine can help you manage your emotions and make clear decisions. So that's all for today. Thank you for joining me for day 27 of our journey. Tomorrow we will dive into another topic. Understanding how to adjust to various market environments can make a huge difference in your trading results. Until then, keep a clear mind, stay focused, and remember that consistency is the key to success. So, happy trading everyone. Thank you.